Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing show. I'm Victor McClure.
I'm Guy Allard. Happy Friday to all of our listeners out in podcast land. How about that? Was that upbeat enough for everybody, you think?
Today's show, remember, for those of you new to the show, I've been on the air for 20-something years.
Long time.
And we call it the Common Sense Investing show because a lot of times if you just break down investing to its common sense components, you can avoid a whole lot of headaches, and you can actually be a lot more successful with your investments. I'm kind of one of those, cautiously, what do they say?
Cautiously optimistic, that's right.
And so I'm always optimistic on things, but I always want to make sure I have all the information. Because a lot of times you got to separate yourself from emotion, which is really difficult to do with your life savings.
Very difficult.
Extremely difficult. It's just like they have a lot of analogies out there. Would you like to operate on yourself? That kind of stuff. So I'm like, geez. So you can say any of those kind of things you want. So what we do is try to give you enough information to help you with your finances. Obviously, we do it for a reason. We get business from it and all that. There's no question about that. But
absolutely. And
this show, unlike any other radio show we know about finances, this is information you can use right now. This is not a 1-hour sales pitch or a half-hour sales pitch on how to come to our next seminar. This is going to give you real information you can use right now.
Maybe we should have a seminar.
Yeah, it's been a while, hasn't it?
Yeah.
Last time we did a seminar was KRLD. We did
the last
Money
Matters.
Yeah, managing their money seminars.
Yeah, that's right.
800 people per seminar. It was pretty good.
Well,
one was like 10,000.
Click.
No, yeah.
You're in line there, a big screen there, and you get to introduce yourself. Hey, a lot's going on in the week. Yellen was interviewed. She's a slow, methodical speaker, but they usually kind of paint a pretty clear path as far as what's on their mind and what they need to do. They're talking, it looks like, this is just conjecture, but looks like they're not going to raise the rate now. Looks like
she said may raise it one time this year.
Looking at maybe December. A couple good nuggets that I pulled out of that was one, they shoot for a 2% inflation rate. That's their number. There's a lot of times it's 3. Historic is 2.6, 2.8.
Yeah, it depends on which measure, but about 3.
And what time frame?
Yep.
So they're shooting for 2. Also, you're probably aware of they're looking at perhaps liquidating their assets, and that brings some issues with it. Anytime that there's a lot of something for sale, it depresses the price.
That's right.
And they've got a lot of bonds and a lot of things in inventory now that they're looking at liquidating. But, one of the interesting things, Victor, I gathered out of that when listening to it, we forget how much effect the QE, or the quantitative easing, had on the market. What they did is they put a number of pillows underneath the market so that the market wouldn't get bruised. So we've got, we talked last week. I think we're talking a little bit today about the market and some of the danger zones and to be careful because of the prices and different things. But it's really been cushioned for quite a while so it doesn't get bruised.
They're talking about, you talk to 9 out of 10 people. If they know anything about the market, they're going to say it's overvalued. But that same 9 out of 10 people probably wouldn't do anything about it.
Oh, I'm not getting out. It's overvalued, but I'm liking the ride, right?
Right. And that's just the way it is. You've got, we talked about Rob Arnott from Research. So he's come out with a smart beta. He said investors are devoid of the necessary caution. In the U.S., there's not enough fear. There's a sense that the risks just aren't there. And so that's one. Rob Arnott, like I said, he developed the smart beta.
But he went on to say later in that article, and this is a quote, "It's hard to paint a rosy picture for any long-term investor. The market is just too expensive," end of quote. And then he went on to say, at any point, it might roll over and die. Now, we know the market's volatile. But usually there's some trends and there's some guidelines and some things that can, keep us fairly safe, certainly along with diversifying your portfolio. But there's so many things right now pointing to a correction or it rolling over and dying, or if it lost confidence, that it would be severe enough to hurt the investors.
It takes usually it's that when everything's happening for no reason.
Right.
Like right now, think about it. North Korea shoots a missile over. Oh, market makes a new high.
I know.
A hurricane destroys Florida. Market makes a new high.
Two in a row, right?
Yeah.
Harvey through
Houston's
Houston.
flooded.
Yeah.
Market makes a new high. We have a 1% growth rate, which is terrible.
Yep.
Yet the market keeps making a new high. That's typically, if you look at it historically, the time to get out. But we're just telling you, we're going to show just some things you should do. I truly believe you should take some money off the table, period. But there are other ways you can do it without that, okay?
And if you're not sure how much to take, or, Victor and I talk a lot about being diversified, taking care of your income, your growth, your inflationary stuff, your liquidity. If you're not sure what those numbers are, call us. We're happy to answer any questions. Even just a phone appointment would be fine. There's no charge. Our number is 972-715-2424. Feel free to call if you have a question.
Yeah, our website's ilovemyretirement.com. Vanguard just came out, which Vanguard is traditionally bullish.
How do they make money? When you invest in the market.
That's right. So Vanguard come out. Here's one of the things that just hit the wire this week. One of the largest fund providers just went on record warning investors about the stock market. Vanguard said is surprised how well the economy has performed this year, but that such performance does not make it more hopeful for stocks. The fund provider says investors should expect muted returns for the next decade. According to Nathan Zahm, the senior investment strategist at Vanguard, but what we caution investors on, particularly given the landscape and given the very strong run we've had, is that forward-looking returns are not now quite muted. Valuations are a big part of the company's worries about returns.
Forward-looking returns are quite muted. We talked about Arnott in the beginning. What did he say? He said it's hard to paint a rosy picture for any long-term investor. Same thing, different words.
If you ever look at a numbers, geek or whatever.
That's what we do every day.
And when you look at it, they're always so bullish on the market after it's made a giant run like it has. But if you look historically, after any 5 years, the market went up for 4 to 5 years, the return the next 10 is always terrible. Even if it didn't go down. You just don't make any hard returns. Now, remember, in a volatile market, what are you doing? You're risking your money for potential reward. And lately, they've been rewarding you. But what about the next 10 years? You're still risking your money for no reward or low reward. So that's something to consider. Remember, the market has only made 4.06% to the beginning of 2017 for 17 years.
With dividends, and if you paid zero fees.
Which is impossible.
Correct.
I pretty much, my customers call.
Right.
And I ask him, like he had made 6-7% on his index annuities over 15 years.
Sure. Depending on the time frame, right?
Well, this one only made 7. I think it made more of my stocks. I go, well, so did mine this year. And he goes, but long term, right? And I go, well, what do you think the market has made long term? And he actually gave me a number lower than most. He said 7.5. He had no idea it made 4.
Yeah.
I said, well, you made 7. You had no market risk. You locked in your gains as you went, and it was tax deferred and judgment proof. He goes, oh, so I made a good decision 13 years ago. Yeah.
That's right.
I go, it's nice to see that because usually it's just the opposite. Oh, if I'd have done something differently, right?
Yeah.
And I'm telling you right now, the market's gone down 50% twice in the last 17 years. Every single person to a man, after it goes down, if I had it to do over again, I would change. I would start taking some off the table, and they're doing it again.
I had to talk to a client earlier this week that took some money off the table, prepared for income, I guess 2 years ago, just before the whole big Trump bump or Trump run or whatever you want to call it. It's taken place, this year and since our election. And the market is up 15%, maybe 20% since he made that correction. But he still had enough in where he was taking advantage of it. And now he was growing his income account. So he was okay with it. I wish I was in the market, but, I've got some of it.
Oh, yeah. Bob Schiller, He's the Nobel Prize winner, also a Yale professor, Nobel Prize winner from 2013. He's the so-called analysis on how to analyze a potential bear market.
Sure.
He said, my analysis should serve as a warning against complacency. Investors who allow faulty impressions of history to lead them to assume too much market risk today may be inviting considerable losses. And so we're not trying to scare anybody with this, but it's starting to come in. Jamie Dimon, I mean, all these different people are starting to come in, and it's getting real apparent. You know, sometimes if too many of them come in, I might think I might get bullish again.
That's right. Yeah, and keep in mind, just regular diversity, a little extra caution. You can't be devoid of caution, like Arnott was talking about. But if you plan for it, it's not as bad. But the one point I'd like to make, depending on your age, I'm 57. Victor's in his early 50s. What, 54?
Yep.
As we get older, it really gets underneath a magnifying glass because we don't have the years to fade a 30% loss. Now, when we were younger, probably the majority of our savings, because you're raising kids and you still owe on the house and all of that's going on. So your savings is where? It's usually your 401k. That's what you can do, and you got a little cash account going. So most of it is in the market. But as we get older, we have to shift it. You'll hear me harp on that all the time. It puts all of these warning signs under a magnifying glass for you, or it should.
There's another thing from Howard Gold that was pretty interesting.
Not Howard Gold.
Yeah.
Oh my goodness.
What
did Howard have to say?
It's from an 8.5-year bull market. Is now the second largest in history. The one thing it's lacked for many of the years is an enthusiastic participation of individual investors. A lot of people weren't in it till recently, and they were people that said, hey, the market's overly inflated. All this government, QE2, 1, 2, 3 has made it artificial. But now they're pretty much throwing caution to the wind and all in. And it's funny if you look at how partisan we are, even with our investments. You think it's just politics.
Right.
Republican investors have a confidence index of 209 points higher than it was third quarter of last year before the election.
That doesn't sound good.
Democrats are 119 points lower in their confidence from third quarter last year till now, because it's all of if your guy wins or gal, then you're confident. If it's not, you're totally pessimistic.
Which is why you should be prepared. And I'm gonna jump in here and say, my buddy Mark Cuban had a Trump hedge on the stock market because he knew the market was going to go down as soon as Trump got elected. I wonder how much that cost him. Just saying.
I know. He did one very smart thing, though. He hedged the .com bubble.
Yeah, no.
$4 billion for .com and didn't lose a penny.
No,
that thing crashed. The .com, they lost 80%.
Well, you can't, when you get that stock, if the listeners don't know, you can't just immediately dump all that, $3 billion worth of stock.
No. He hedged it and did great, so that's very smart. The Wells Fargo Gallup Investor and Retirement Optimism Index hit 138 in September. That's the highest level in 17 years. Last time it was that high, the beginning of 2000, investors still couldn't believe the .com thing had busted, and we know what happened right after that. It's 98 points higher than February 16 when the oil prices were going down. 68% of investors now are optimistic about the market performance for the next year.
But
it's just what's done lately.
Let's go back just for a second, if we can, and revisit the 2000 numbers. What were they again? You just said
2000. The last time the optimism index was this high was 2000.
Okay, and to refresh everyone's memory, in 2000, if you don't remember, obviously the tech bubble and all of that. People were in the market that shouldn't be in the market. They weren't right away, right? They waited. They waited. They were on the sidelines. They didn't do it. They were probably allocated properly. Then at the last moment, they all got in the market. They had all their money or most of it in because all their friends were making 40% or better a year. It looks like, it feels like the indicators are like that's happening right now.
The weird thing, who would be who the most optimistic people are about the market is really confusing. Retirees.
Yeah.
They would think they would be more cautious.
Absolutely.
They are the most optimistic. They have a 158-point confidence score. It's weird. I've also read so many things about millennials.
Yeah.
They don't like the stock market. Only like 20% believe in the stock market. So what does that mean for the stock market of the future? Those are the people investing in the future.
Right.
They didn't grow up in the years we did, where the stock market from the 70s, 80s, was going a certain direction. It's like my father back in the day. They were split up in camps. The commodity camp in the 70s,
Right.
that was killing stocks.
Right.
So they were all commodity guys. Then everybody transmuted over to stock guys.
Which is a much larger market, right?
Yes. And so there's all kinds of different things, but everything seems to be pointing. Now, we don't want to go on and on because I can give you lots of people, but there's also other people think it's going to go up. I just can't find the academics that are doing that. Usually it's an advisor. They manage a hedge fund, which is to their benefit that this thing continues to go up.
Well, think about what the odds are of you totaling out your car or your house catching on fire and burning down and you're losing that asset. There's a minute chance that these things will happen, but yet we would never go uninsured. In fact, the government makes you get insured. The mortgage company, if you have a mortgage, makes you make sure that you're insured from that loss. The market has got warning signs. The odds are much greater that something is going to happen.
It's a 1 in 1,000 shot your house will burn down
and
or get broken into. It's about an 80% shot the market will have a correction.
1 in 1,000 versus an 80% that this is going to happen. What's it worth to you? What's the value of insuring your retirement or insuring your funds and make sure you don't have to suffer that loss?
But the thing is, it's a hard sell because like this one, what Thomas Key was saying, they've been told this for a couple of years and it hasn't gone down. And so it's like the boy who cries wolf, no matter what. They've been saying this from all these so-called experts.
Been hearing it for years, a couple of years now,
right? It keeps going up.
That's true.
So obviously the experts don't know anything.
That's right.
And so, but what this person's saying, and this guy's he's a stock trader, a stock trading website, big guy on stock trading. He says all this liquidity they're taking out of the market will crash it. It kept it up for longer than it should have.
Right.
With a tepid 1% growth rate, the market shouldn't have gone up 300% from the low. He goes, but you take that liquidity back out, which every central bank in the world is planning to do.
That's right. Absolutely.
It
Good
will
point.
hurt it. There is no way. So what he's saying is, I understand. You don't believe it because everybody's been saying it forever. All these so-called radio experts have been talking about the market's going to go down, and it still hasn't. And so, and you also understand a lot of those perennial bear analysts, they're going to be right eventually. They tell you for 10 years, okay, it finally goes down. No, they're finally right.
Oh, now they're a genius.
After I've missed out on all these returns.
I predicted that.
But these are people we're talking about that are not traditional bears. These are people that are traditional bull market people.
Yep. And they make a living on the
Yeah.
market.
Yeah, the one guy is Stock Traders Daily. It's Rob Arnott with the Smart Beta. It's Schiller. All these are pro-market people. That's when I'm starting to get a little upset. Not upset, but cautious.
And
It's not the perennial bears. It's now the bullish people are saying, wait a minute, this thing is way overvalued.
And you may wonder, with our concern here and with the signs, what do we do with our clients? Do we pull them all out of the market? We haven't done that. We've got some very good managers that invest in sectors, and as one does bad, they pull out of that, and they readjust them as the need be based on the market indicators. But we make sure that the income they have in retirement is guaranteed, so that won't be an issue. Victor and I talk about it all the time. There's two types of retirements, right? There's a guaranteed retirement, and there's the non-guaranteed version. We talked about the money and the extent that you go through to make sure that your home is insured, that your car is insured, so you don't suffer that loss. We do the same thing for folks with their retirement.
Yeah, you're insured. Your expenses are going to be paid. Your expenses will be paid the rest of your life. But also, remember, there's a couple ways you could take some off the table.
Right.
That's definitely an option. Some of the fixed income alternatives aren't great right now. Getting 1% on a CD, 2 or 3% on a bond. But it's better than the alternative. Think you might miss out on that last little piece, but you might save yourself a 50% loss.
Don't you think that's keeping people more in the market because their alternatives
Absolutely.
are like nothing?
Absolutely. You've got, okay, I'm going to pull, now think about it, Victor. You're telling me I made 20% since Trump got elected. 20%.
Right. That's right.
You're telling me to get out of that and put it in some crappy 1% or 3%.
Maybe 1%.
Yeah, that's right.
If you do short term.
I get it. But I'm telling you, every single time throughout history, if you just started taking some off the table, every one of those up here, start taking some off the table, you end up better off every time.
Not only take some off, you probably want to take a little extra off. Our guys are still in the market. We've got some great traders, but we're going to take a little extra off.
And also remember, if let's say you just can't pull the trigger, no matter what, you're going to stick with it, even though you know. I talk to people every single day. 9 out of 10 of them say, oh, I know it's going to occur. 9 out of 10 of that same people won't do anything about it. But you got to look at, like our managed program, at least have an exit strategy. Remember, it's in every sector of the market.
Right.
If any sector goes below it, it's 100% liquid at all time. It's fee-based. There's no commission, anything like that. If any sector goes below its moving average, it's automatically out of that sector. Now, is it perfect? Well, it can't be perfect.
Nope.
It's in the stock market. You always have risk in the stock market. But it's specifically designed to limit losses but extend your gains. Because let's say it doesn't happen. Oh, they cried wolf again. The market's going to turn it. It went up another year. Well, you're still in it.
That's right.
You're still making money, so you didn't miss out, but it's got the protective features in there. The protective feature a lot of people has is when I feel in my gut it's about to go down. That's a terrible measure, by the way. Do not trust your gut in the stock market. It'll always, because all you do is think of recent history. Like right now, the optimism index is up huge because they've made money lately. You took it back to before the election, the market actually didn't make money for a year and a half.
That's right.
And the optimism way down.
That's right.
The optimism means nothing. It just means what they've made lately.
And we had a big event, the election.
Yeah. When you got the PE ratio that's almost double what it is normally, that's a bad sign.
Guys, all it's going to take is a big event. You know, the Trump election, whether you like Trump or not, I'm not going there. But it was a big event, and it built a lot of confidence because of the promises and what happened. It sustained this great bull market that we've had. Think about the reverse. Just one little bad event happening, whether it's Korea or Iran or anything, just a bad event. What's going to happen?
Yeah, you got the wealth effect of real estate. You know, when people's real estate's going up, they feel wealthy.
Absolutely.
They invest more. They spend more. Those are the facts. And all of this stuff would have crashed a long time ago without this quantitative easing.
That's right.
All this money and inflow they put in there, it did one thing. It accomplished that goal. The markets didn't crash. But that cannot continue. They're going to start unwinding that. So how can it continue with a 1% growth rate? You know, we're talking about, I read Trump's plan for the tax reform. And they're hoping, if everything went perfectly,
Right.
that they get 3% growth, which would be 3 times what we're getting now, right?
It's a good number.
Right. But that's if everything goes perfectly. And you know, I've been around 50-something years. I've never seen anything that came out of Washington that was perfect.
Well, and they're,
If it's better, I believe in it because I'm a conservative. I believe in it.
not to get too crazy, but they're talking over the next 10 years, the debt going from 20 to 30 trillion dollars. That's not sustainable.
So all of those things, you know, a lot of people don't believe it because, well, it went from, 1 trillion to 10, didn't bother me. Didn't affect my family. How about 10 to 20? Nah, same thing. Because when people are, sometimes something has to come to roost. You got to be careful.
Got to pay the bill.
But remember, let's say we've got clients right now doing things, they're taking some out, and we got some index annuities that are more geared towards growth. And if you run rolling 10-year periods, the worst they've ever done is say 4 or 5% a year. Now, wait a minute. We just said taking money off, people are very reluctant to do that because of a 1% CD or 2% bond. What if you could take your losses, lock in your gains,
Mm-hmm.
but get a worst case 4% for the next few years? Remember, even Vanguard says the next 10 years will have muted returns. You're not going to get much return on the next 10 years. You only got 4% for the last 17. But I'm telling you, when I asked that question,
So what does a muted return look like if it's been 4%?
if 4% was great, what does muted look like, right?
Right.
So, but they don't think that way. They're thinking of since the bottom of the market when it lost 50%, it's gone up 317%. I get that, but that's still you got to add the whole thing together. And 4% a year is all we've got this century. And now every expert I can find is thinking it's going to be less than that for the next 10 years. So, in my opinion, I don't mind risking money. I'm in the stock market right now, and my account has done fantastic. The clients' accounts have done fantastic. But I keep to my percentages. I don't get overly emotional or optimistic. It doesn't mean this market's going to, my 401k or whatever, 20%. Does that mean I'm going to tow everything in the market? Nope, I haven't changed the allocation at all.
You know, one of the advantages we've got, Victor, is we've seen some quote unquote geniuses do really well for quite a while, and then not so much.
Maybe I'm too pessimistic. Maybe I think too much and I'm too cautious. That could be. But all I know is I've never taken a big down year. I've never taken a 50% down year. My clients haven't taken a 50% down year, even though the market lost 50% twice in the last 17 years. That's what we do.
We've had clients leave us in the late 90s. I know that's a shock to everybody because we weren't aggressive enough during the tech run-up.
That's right.
And, of course, you know, when they do that and they leave and they go somewhere else and they end up losing 40% or whatever the number is, no, they don't call you back and say, hey, I'm sorry, I was wrong. They just kind of disappear into the sunset.
That's right.
But we've had clients leave because we weren't aggressive enough for them. They wanted it all in techs, and they were 70 years old or 68, and they were in retirement, and they wanted all this money, and we just couldn't do it.
Oh, I know. It's weird. A lot of people get aggressive for the wrong reasons.
And the people with the least amount of money really are aggressive because they want to double up to catch up.
But he always asks me, what's the difference between wealthy advisors, and customers you have, and regular customers? You know, regular customers might have, 500,000 to a couple million. Wealthy might have 10 million plus.
Right.
I go, here's the main difference. They don't tell me you better make 15% a year. The first thing a wealthy investor tells me is you better not lose money.
I don't want any risk. And a lot of them say, I don't want any risk.
Remember, they've already won the race. Why are they going to keep running? They said, don't lose money. If you can get me 4 or 5% a year, maybe 3 to 5% a year, and I don't worry about the money, you have the business forever. That's what wealthy people are.
I just got a new client a couple weeks ago that we'll just say 10 million plus. And very first thing he said is, I don't want any risk. So if you feel that way or if you have any questions, again, our number is 972-715-2424. That's 972-715-2424. We're happy to spend some time with you, answer some questions, give you a little philosophy, see if our philosophies match. And if they do, we welcome you to come in.
Give us a call. Also, if you like this format, we did a normal commercial format for 20 years. We're trying the commercial free for 30 minutes, but some people like it, some people don't.
Yeah, we'd like to know.
Yeah, if there's breaks in there, because we'll throw some breaks in there if more people like it. So you call us, and we'd love to hear your feedback on that. Also, if you have any friends, send us their email address or whatever. We'll put them on the list so they can receive the show every week. Now, you can get it on YouTube, SoundCloud, podcasts.com, all that different stuff. But a lot of times they'll forget it. So we send it to everybody, so remind them, hey, just click here.
And if you don't want it anymore, I guess tell us that too, and we'll take your name off the list.
Our phone doesn't work for you folks.
That's right. Anyway.
No, we're just kidding. But remember, there are strategies that can allow you to stay in the market if you just have to, no matter what the evidence says. But it has an exit strategy. The most it's ever gone down is about 7%. Now, that's not perfect, right?
No.
But the market's lost 50 twice. So that's what you want. At least have something that, if it continues, who knows? This tax plan might go through. It might go up more. Whatever the case, you'll still be participating.
And I know
we have other products that will lock it in and guarantee you give you a participation in it.
Yeah, I was going to say, and it's not as exciting.
Right.
The range, like a rolling 10-year average, every year that passes gives you another 10-year period, is somewhere between 4 to 7% on average. Not as exciting, but it's safe. You get a portion of the up years and none of the down years. Some of them have no fees, etc.
Well, that's our show, folks. I want to thank everybody for listening. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.